Hey everybody, happy 2022. I am here with Matthew Hibler, team lead of the Hibler Group here in Denver, Colorado. Matthew and I have worked together for nearly 16 years. We go way back. I trust he and his team implicitly. That's why I'm having him here to talk with about a really big topic as we move into the year 2022. And that has to do with interest rates and specifically the difference between the Fed fund rates and mortgage rates. So Matthew, thank you so much for joining me here today.
No, it's such an honor, Zach. Thanks for having me. Nice to see you. And I'm happy to get this information out. I'm sure clients of yours and beyond will benefit by learning about what's happening in the marketplace. So
there's no question. I mean, truthfully, this really is one of the biggest and hottest topics that I'm seeing kind of at the end of last year as there were talks, especially in the media, about interest rates going up. But we know enough about the media that, they like to sometimes sensationalize stories, but certainly, get clicks and views. And so I think it's really important that we really look at what it is that they're talking about in the media versus, which is the federal fund rate versus, mortgage rates. So
it's certainly all over the news. The Federal Reserve, their meetings, how they're adjusting their agenda, et cetera. I mean, it's all over the top of the news. So you're right. Yeah. People are asking.
It sure is. And it impacts so many people too, right? I mean, the majority of adults in our country, it has a direct impact on them.
Mm-hmm.
So, looking at what the federal funds rate, diving into it, federal funds rate versus mortgage rates. The news speaks of, like we've talked about, the federal funds rates or the Fed funds rates. Can you explain to the viewers how this relates to or affects mortgages?
Certainly. And I just want to add that there is a lot of confusion. So if somebody's listening to this and they're saying, yeah, I'm also confused, know that that's totally normal. And
by the way, I'm one of those people. It still confuses me.
It's funny. I'll explain why. There's one piece here that I think is really relevant just to help people kind of have clarity around this. The best way to explain it, if I summarize, is that the federal funds rate is an index that then banks set consumer loans and debt against. And it's a short-term index, so short-term debt. Whereas mortgage rates obviously are long-term debt. When you think of a 15, a 20, 25, or a 30-year mortgage, certainly that's long-term. So the federal funds rate being an index in the short-term debt markets, the mortgage rates being a rate that's the result of what's happening in long-term debt markets and trading, that's where the difference comes in summary. So the piece that's really confusing is that you can get other types of debt against your home, for example, a home equity line of credit or a second mortgage. Those typically are indexed against a short-term benchmark rate, which then ties in really well to the federal funds rate. So if I have a primary mortgage, let's just use an arbitrary example of $500,000 against my home, and I have another $500,000 of equity that I could tap into. A commonplace set of events is that somebody looks at their options and they decide that they're going to open up a home equity line of credit, which means you're accessing arbitrary number, $100,000 of your $500,000 of equity to then use for a housing project or a kid's tuition or whatever. The list could go
down payment on another investment property or something like that.
That's right. There's lots of creative use. Absolutely. Well, when the home equity line of credit is opened, typically the banks, credit unions, lenders, they'll index the interest rate on that home equity line of credit against a short-term indice. Typically, it's the prime rate. Okay, so there's this prime rate that banks will then watch and set their consumer debt rates to. The prime rate moves in connection with the federal funds rate. It's all part of a short-term debt market. But the reason I bring it up is that when you look at a housing-based loan, like a home equity line of credit, that is directly impacted by the federal funds rate moving, like a home equity line of credit, there's confusion that sets in because then people think like, well, okay, does that affect mortgages or home loan debt or not? Just to reiterate, the long-term typical or traditional mortgages are long-term debt, and that's based in a totally different market, a long-term debt market. most of which is comprised of bonds and bond trading.
Okay. And is it generally true then that as far as mortgage rates go, when there is positive economic data, mortgage rates increase, and when there's negative economic data, mortgage rates typically decrease, that it's more tied to the overall economy.
Yes, that in general is true. That then there's lots of moving parts economically, as you know, that filter through and then move long-term debt markets and rates versus short-term debt markets and rates, et cetera. What I think I'd focus on, if I had to pinpoint something to answer your question, is risk. So investors are recalibrating what they're buying and where they're investing based on what the risk is in the economy. So lots of moving parts here. But in general, your basis is right. Okay. The other piece that's really interesting is that I read this really nice analogy, so I'm going to use it here. The analogy was that the short-term rate indices, like the federal funds rate, and then how bonds are trading, or long-term indexes for setting mortgage rates, et cetera. The rate indexes can work together like dance partners. Sometimes they're dancing together. Sometimes they're on their own, dancing individually. Sometimes one has to catch up with the other, and then they're moving in the right direction. You know, it's just an ebb and a flow. But the pace is certainly different. So if I just lean into that a little bit further, here's an example. If there's bad economic news, like the unemployment rate spikes upward, investors in general, investors meaning lots of money, billions of dollars, will evaluate risk in the economy, and they'll say like, there's bad news coming here. They can quickly trade and move out of short-term risky investments, right? So like the short-term markets will move right away. Typically rates will go down because then that's an attractive safe haven to put money rather than a riskier place like the stock market or a short-term place to invest.
Sure, that makes sense.
I think when there's bad news, typically the short-term markets will just adjust real quick. Well, then following suit, of course, long-term debt markets will adjust too. But when investors tie up money into the long-term market, they have to make wise, calculated decisions because they're buying long-term debt, which might be a little bit harder to move in and out of. Whereas short-term debt markets, you can move in and out of and be real agile quick. So there might be a lot of movement in short-term markets, a little slower movement in long-term markets, and then eventually they might catch up to each other. So could these rates and could the markets move in tandem? Yes. Typically, there's lag time. Sometimes they can move in opposite directions, and it's all just based on risk and what's happening in the economy.
Okay. All right. Thank you for clearing that up. That makes a lot more sense. So a question about Fed supports in the mortgage markets. That's with mortgage-backed securities. We've been seeing that, that's also in the news. What have they been doing and what will change this year? Yeah.
There's a lot that's going to change this year. I'll try to pinpoint what I think is the most relevant. Okay. I don't know. That's an overview or probably a protective disclosure. Okay. But there's so much moving. I feel like we have to do that. What's interesting to answer your question is that the Fed has been buying mortgage debt to keep long-term consumer rates low, like mortgages. It's been a safe place to put money while they work through like what's going to happen to the economy through the pandemic. It was a good place to put dollars, a lot of those being taxpayer dollars filtering up into the government, of course. So we want them to have safe investments, of course. Right. But they made consumer debt really attractive to keep the real estate market moving, to keep mortgages looking attractive and the economy humming along. So the Fed was buying mortgage debt to support rates. Well, at the same time, they slashed the federal funds rate, which is the index on short-term debt markets. They slashed that down to 0 to 0.25%, which is really just the index of what banks have to pay in interest if they borrow money from reserves with the Fed to keep the bank fluid and cash moving, et cetera. Okay. So the Fed sort of made all these moves in tandem, which made all short-term and long-term debt markets adjust along with each other into really cheap money, right? Really cheap debt. Well, now, they're reversing course and they're doing things in tandem once again. So the federal funds rate will be pushed upward by the Federal Open Market Committee. That's typically, members of the chair of the Federal Reserve. They'll push that up because the economy seems to be strong and doing just fine. And they have to fight things like inflation, and I could go on and on. Yeah. But they're doing that. And then in tandem, they're backing out of the mortgage market because they believe, well, there's room for rates to go up. And with the housing market being as hot as it's been, let's set the interest rates responsibly, where buying and selling mortgage rates and long-term bonds and locking in mortgage rates on new home purchases, et cetera, are probably at a more even trading level, right?
Okay.
With the housing market being so hot, they believe they can charge a higher rate. The economy could potentially not be that affected, or maybe the pace of real estate gets to a potentially more balanced point. I don't want to say balanced point, but a more balanced point. And that's happening at the same time that they're moving the short-term index. So if somebody called me and said the federal funds rate went up last night, did mortgage rates go up last night? Potentially, yeah, they could be moving in tandem because of what the Fed is doing in all these different facets.
Right.
But I just want to say,
like in the dance partner model that you gave us, they might be dancing together at that point.
They're dancing together at that point. That's right. Right. So I think that could hold some truth. But in the past, I've honestly had it where I've had clients call and inquire because the federal funds rate, the short-term index, had dropped, and they thought, well, that must mean that mortgage rates dropped. When really in the long-term markets, there wasn't much activity that influenced mortgage rates. So the short-term index dropped, but mortgage rates stayed steady in that case. And that could hold true at some points over the next few years.
And I get that question a lot too, from people where that's like, I'll have a conversation. They'll say, I read this, I heard this, does that mean that interest rates, is this going to be a good time to refinance? And that's where I say, I don't know. They need to talk to you to find out.
Yes. And it's funny because, of course, I'll give my opinion. It's really hard to be perfect in my forecasting of how will short-term debt movement and what the Fed is doing affect these long-term mortgage rates. I can get pretty close, with enough experience, 18, 19, 20 years in the business. I can give pretty good advice, but of course, it's just hard to know what the future brings. But it does seem like this is finally the year, after lots of years of mortgage rates sort of trending downward. This is finally the year where probably the trend's reversing and mortgage rates will go up. The experts say that, by the end of 2022, we should see an APR at a 30-year fixed just below 4%. 3.8, 3.9 APR, which is a full percent increase versus where we ended 2021 at an APR and a 30-year fixed on average of about 2.9%.
Yeah.
So I think we're going to see rates go up.
Well, so I guess that brings up, my next question is, that's what the experts are saying, and you certainly are an expert. Where do you think mortgage rates will be over the coming year, 2 years? And then also, how does that compare to historical rates?
That's such a great question. Even though rates are going up and will end higher this year than they did last year, like we just said, money is still cheap, quote unquote, in general. Money is still cheap. Mortgage rates are still low in general. So to go further on that, I tend to believe those reports that I've read so far, forecasting that mortgage rates end at or just below 4%. A full percent increase and rise in a mortgage market is a decent amount. It's a pretty big increase relative. I think that Fed officials and those in the financial markets that have the power to set rates and borrowing cost, they probably want to see how the market digests a full 1% increase. And if the market shows that it can continue to be strong, say the housing market, and all the markets related, or all of the industries related to the buying and selling and trading of real estate. If things stay strong in general, then probably we see further increases after that. Finding a balance of where buying and selling and industry and markets can sort of still be harmonious, and the economy can still be in a really good, strong shape. Investors are going to test that at this point because there's room for rates to be higher and markets to still function. So investors, I think, are going to test it. To answer your question specifically, I think if we say a 4% rate, APR, 30-year fixed on average, good credit, borrowing power, et cetera, I think that's about accurate for the end of the year. And if we beat that still in the 3% range, I'll be thrilled because, like I say, that's really cheap money.
Yeah.
The other thing you just asked me was, historically, how does that match up? Well, Fannie Mae and Freddie Mac set industry standard and underwriting requirements and all kinds of rules for the mortgage industry. I turn to Fannie Mae and Freddie Mac quite a bit because behind all of their rulemaking and industry direction they have good reporting on what's to come and what's next. So they have, as a result, a historical graph. If you go to freddiemac.com, and the spelling, a lot of people just need clarity on that. FREDDIEMAC.com.
Yeah.
Freddiemac.com. Their website I love. I go there most mornings, to be honest with you, just to read articles on what's relevant to the mortgage market, what's to come, et cetera. Well, if you click around a little bit, you'll find historical rate graphs. FannieMae.com also has that. And if you look at a 50-year graph, mortgage rates will show to be as high as in the 18% range.
Back in the early 80s?
Back in the 80s, that's right. Mm-hmm. And then trending down, all the way to in the 2s here this year, which is just amazing. I can't believe that we were locking so many mortgage rates in the 2% APR range.
I know. Well, when I bought my first house in 2005, I remember I was excited to have a 6% interest rate. It's all perspective. But historically, there's no question it is, it's towards the bottom of where it's been. So I think it's really important for people to understand that even if rates do go up to 4%, that it is still historically among the lowest that we've experienced in history.
Absolutely. So, yes. And I'll add, Zach, just one more thing that pre-pandemic, so, first 2 months of 2020, the average APR was somewhere around 3.5, 3.6. Here we are today with a lot of negative, like off-selling of bonds and mortgage-backed securities, pushing mortgage rates up. And after all of that's happened and a lot of recalibration of money, based on the Fed's agenda this year, we're at 3.5 APR in general all of a sudden today on an average 30-year fixed APR. Yeah. So, we're at the lowest level pre-pandemic we had seen, roughly. The low rates that happened during this pandemic were really a gift. Mm-hmm. So, like you say, perspective needs to change. I think in general, money is still cheap, and holding a mortgage even at 4% really is relatively cheap money and still a wise decision. So yeah, I agree with you. And I think so much of it is that education too, educating people on this. So before we go on, I just want to mention that, and I do have a few other topics to cover here within this topic. But for any of you watching, if you do have more questions about this topic or any others, you can find Matthew's contact information below. He and his team are rock stars. They're so amazing at education. That is so key, education with clients and explaining the best options and talking them through this so that they have an understanding. And I think that's really what sets you guys apart. So just wanted to point that out. Also, the next question I have here is has to do with affordability, being a focus for home buyers. And if rates go up, what do you see as far as the impact on housing and mortgages? Well, and I love that. I love that we get to go back and forth a little bit on that right now. Of course, we could bore people to death right now, but you and I over the years have really been strategic with certain home buyers where, let's say the rates do go up quickly, the borrowing power is lessened. At that point, there's all these creative plans that we can put together to help somebody sort of recalibrate their whole housing search. Let's say instead of buying $1 million, they're buying $750,000. Well, then we can get really creative where we shrink the down payment amount they were going to put down. They hold cash. They buy the $750,000 home with more cash, and they fix it up so it's resemblant of the $1 million home. But their borrowing power on a monthly basis stays low. Yeah. They put a little bit less down, lesser home, but then the elbow grease, as they say, with the cash that they didn't put down allowed them to make the house better, and now they're really happy. So I just bring that up because, we're back and forth here on price point and borrowing power. All these creative plans can be put together with a few hours of time and some conversations between you and I, and housing dreams can be made true. So. Sure. And I mean, that's a great tip too. Do you have any other, strategies and tips for homeowners and perhaps hopeful buyers in, here in 2022? Yeah. So this is funny to talk about. But look for the adjustable rate mortgage market to come back. Oh, I say come back, and then I'm going to add responsibly. Those of us who were around in the downturn of the 2007, 2009. I mean, that was the ARMs. The adjustable rates were problematic then. Absolutely. The regulation was was non-existent in the mortgage industry or over the mortgage industry. And those ARM programs were really exotic. Interest only, adjustable rates, pick how much you want to pay this month. I mean, it was just really ridiculous. Mm-hmm. But the principal and interest payment adjustable rate, so the ARMs, which is an acronym, adjustable rate mortgage, they're going to come back making affordability sort of in scope again. So quick example, if the 30-year fixed mortgage rate goes up to 4 or 4.5%, a 30-year loan where the rate's only fixed for 10 years, right? So now the investor knows they're going to get that money back on the books and be able to lend it again in 10 years, maybe at a higher rate. They'll make that more attractive. So the rate could be 3.5 APR arbitrarily. That fits the bill for a lot of people that believe they're going to be in their home 10 years or less. Now rates went up. We looked at other programs that might fit somebody's requirement. Affordability got back into scope, and now, they continue their housing search. So, I think more communication with a mortgage lender as you start your housing search at this stage with mortgage rates going up is going to be really critical. I just want to use this because this is my chance to make a joke about online mortgage lenders. You could go to these big companies that are mostly online, rates are going up. Is the computer or some team member that's sort of diluted in your loan process going to make really good tips and advice like that to you? Probably not. Right. So I see a lot of sort of redirection into local mortgage lenders that can be an expert, keep affordability in scope, and make housing transactions happen. Our job security all of a sudden is amazing.
No, that's a great tip, and especially about the adjustable rate mortgages. That's something that I had not thought about, but that's good to know now as something as interest rates eventually do increase, which is we're having this conversation. It has been several years in the making that we've had these conversations every year. Oh yeah, I think this is going to be the year that mortgage rates increase, and I think this really is the year that we're going to see that happen as we move forward.
Absolutely, and as long as on the adjustable rate piece, just as long as the home buyer or the applicant knows the risks associated and is really clear.
All that education.
It can be a wise choice. Yeah.
Sure. Okay. So a couple more questions I have here. So what are the biggest changes that you see to the mortgage industry that you would tell somebody who's maybe buying their third or fourth house to not take for granted or consider, maybe that they have not in the past, and may not have in the past?
And that's a wonderful question and timely. It really relates to what we were just talking about. Underwriting requirements are now responsible. They seem a little restrictive, but when a mortgage applicant applies for a mortgage and we start underwriting a loan, in the mortgage underwriting process, everything's uncovered. How much debt do you have? Have you been paying your bills on time? And, we get a pretty good picture. The credit reports are an amazing wealth of information. I mean, that whole practice has improved so much the last decade since the meltdown. But I think I would just say, applying for a mortgage, although, me and the team, for example, make things seem as streamlined as possible, there are a lot of moving parts happening behind the scenes. With rates going up, like if somebody's pre-approved and starts their housing search with USAC and inventories stay low as they are right now, and it takes them 9 months to find something, rates could adjust a lot in that period of time. And if somebody has just a simple pre-approval, they forget about it. 6 months go by, they find the house, they come back to lock the rate, and they go, wait a minute, that payment's a little bit different than I expected.
Sure.
Having a mortgage partner that you trust is really important. So don't take for granted a simple pre-approval. This should actually be what I call a mortgage conversation ongoing throughout the housing search.
Yeah, totally agree with you. And a couple of things to add on to that. One is when you have new construction, those homes are being 9, 12 months out. That's until they're able to purchase. So their rates are going to be different. And letting them know upfront about that, not just you, but I the same for me. When I'm talking to people. And the second thing is what I always do when I'm first meeting with people is let them know, back to what you said about the documentation. I'll tell them, hey, it might be a little painful. They might be, the lender might be probing a little bit more than you think they should, but that is the nature of it. And that's what's helping keep us from falling back into a bad, old patterns and bad behaviors from the past.
Right. Yeah, I mean, right. So the housing market's been on this amazing appreciation trend. Affordability, like we keep talking about, is a thing. And a lot of people call me and say, like, when is this going to end, or when will housing prices soften, et cetera? Well, the last time that the housing market softened, it was because of bad mortgage loans that people really couldn't afford. So we're all now doing our part by documenting that we can afford the mortgage during the mortgage process to ensure that good loans are being written, our housing market stays stable, which really in the end protects everyone. So absolutely. It's a great topic to cover.
Yeah. Well, so do you have one final question? If there's anybody out there, Matthew, that wants to follow this data and kind of the conversation that we're having here right now, who do you recommend that viewers out there follow?
I love that. So if I'm neutral on this answer, I really like mortgagenewsdaily.com. Mortgagenewsdaily.com. It's a place that I go, one of many, just about every morning. Great articles related to what's happening in the mortgage industry, what to look for and what to expect. Also, Freddie Mac and Fannie Mae have their own homepage, and through there, the website then becomes really extensive. Wealth of information. I encourage people to go there too. I also have a great webpage where you can do amortization calculations on a mortgage payment calculations. Matter of fact, you could go here and answer that question that Zach and I just covered a little bit ago, the difference between 3 and 4% on my mortgage calculator, right at denvermortgageshop.com. So denvermortgageshop.com. And if you scroll down the homepage, I've got a mortgage calculator right there. But between those couple of resources, I think that any home buyer could feel really well educated.
Awesome. All right. Well, Matthew, thank you so much for your time today. I just really appreciate you sitting down with me here to help answer, questions that are certainly on people's minds these days.
Oh, such a pleasure. Zach, thanks for having me, and thanks for doing the interview.
Yeah. Well, this has definitely been enlightening for me, and I know that everybody who's watching has learned a lot. Like I mentioned earlier, this topic affects nearly everybody. And, we're just looking forward to what 2022 has in store. Thanks again, Matt.
Thank you, Zach.